Good morning, everybody, and welcome to our July edition of our Economic and Investment Update. My name is David Baker. I'm Chief Investment Officer here at Mazars, and I'm joined as ever from Athens by our Chief Economist, George Ligarius. We'll spend half an hour or so just talking through what's happened in the economy year to date, and then also look at what are the key drivers of what's affecting investment markets presently. And then hopefully we'll have about 10-15 minutes at the end to answer any questions. Thank you to everybody who has pre-submitted questions. We've got rather a lot this month, which is great and probably not surprising given the volatility in markets. So it may be that we can squeeze other questions in if people want to post them as we go, but you'll forgive us if we don't get to everybody's questions, because as I say, we do have quite a lot pre-submitted. If you did want to ask a question, please can you pop it in the Q&A as opposed to the chat, and that'll help us just pick it up as we go. So without further ado, let's flick on and see what is, as the title says, a very negative picture in 2022. Unless you were speculating on the US dollar against the Japanese yen, or you were heavily invested in the oil market, it's been a pretty miserable time for investors. So everything on the left-hand side, you can see there are equity markets, Japan, Europe, US, emerging markets, all down. The only market that's up is the UK, 0.4%. These were figures to about a week ago, and probably improved a little bit since we put this chart together. But interestingly, look at the difference between the light blue bars and the grey bars. So the blue bars are in local currency. The grey bars is when you convert it back into sterling. So because of primarily the strength of the US dollar, for anyone with international unhedged equity exposure, it hasn't been too bad because the dollar's been so strong against the pound and indeed all other currencies. And you can see that coming through in gold. We've got a reasonably big gold position in our portfolios, and although the list price of gold has fallen, when it comes back into sterling, you've actually had a reasonable return year to date on gold. Copper is interesting. Copper is often seen as being a bellwether for the health of the economy moving forward, because it indicates demand for sort of industrial processes, and copper, suffering down 25% year to date. So, all in all, pretty miserable stuff this year. We've said it before, let's not forget the very good years that we had in 2021 and indeed 2020, despite everything that was happening in the real world, in the financial markets. Those 2 years were pretty buoyant. So a little bit of selling off from some probably overinflated asset prices, and we'll talk about that a little more in the coming slides. So let's flick on, because as we always say, the headline numbers don't tell the whole story, and there you can see global equities just split into the main sectors. Energy obviously stands out massively on the left-hand side for obvious reasons with what's happening with oil and gas prices. And if you've been following the news this week and what Russia is doing with the Nord Stream 1 pipeline, it's probably reasonable to suggest that energy inflation probably very uncertain as to whether that's going to go away anytime soon. But the three sectors that we've put in the box there are the sectors that we've been rotating to within our portfolios in our April and June investment committee meetings. We moved more towards the defensive end of the market, those areas that have a little bit more resilience in an inflationary environment. And note also the difference between what the return on consumer staples has been, the third bar from the left, and consumer discretionary right on the far right, which has been the worst hit of all the sectors. Interesting results out of Unilever yesterday, where they said their volumes down 2%, but actually they've been able to increase their prices by around 11%. So not a disaster for Unilever in that consumer staples place, because of course we do all have to go and buy certain things. Whether we might switch brand or switch retailer is another matter, but certainly that space a lot more resilient than consumer discretionary, which has been hit quite hard. Although I was listening to the chief exec of Lloyds Banking Group on the radio this morning saying that the data that they're tracking from their customers' spending patterns shows that actually they are still A, saving, and B, spending on leisure activities as well. So maybe that consumer discretionary area a little bit overdone. But as ever, the headline doesn't tell you the detail. And this is where we think active management in portfolios is going to be extremely important moving forward. So let's have a little look at rates, because we've said this for as long as we've been doing these webinars, essentially, that it had appeared that equity markets, and in particular US equity markets, and within that the technology space, was looking very expensive. So when you look at the left hand side of that chart going back just as recently as November of last year, you can see this massive disparity between rate expectations for the end of 2022 and where US equities were valued. And we said at the time, it is a case of there is no alternative. Interest rates being so low didn't necessarily justify the valuations on that US stock market, but it didn't necessarily explain them. So as we've seen inflation come primarily from COVID and then from the war in Ukraine, we can see that, those inflation expectations driving monetary policy, driving interest rate rise expectations, and therefore that's when you've seen the sell-off in US equities, and there's a very clear negative correlation between those two things. So we've got the US Federal Reserve talking today about what they're going to do with interest rates. We expect another 0.75% on top of existing rates to take that rate to about 2.5%. The market expects them to continue to do that. It's around 3.4%, the expectations for the end of the year right now, and we think that's probably about right. So an end to this environment where everything looked expensive. We've now seen a bit of a sell-off simply because there's been a significant change in monetary policy in response to inflationary pressures. So that's what's brought about the volatility. What that's actually meant to markets, we already had a little look on the first slide, but I think it's worth just reiterating that on the next slide, of how this particular sell-off in markets has been different from those that we've seen in recent times. And by different, what we really mean is it's affected both equities and bonds. So all of the bars to the right of the first bar, which is the current year, are sort of instances that we've seen in the last 10 or so years, in fact going back to the global financial crisis. So Eurozone crisis, little scares around Chinese growth, and of course COVID. And you'll see the dark blue lines, which is the S&P 500, i.e. equities. They've always been the significant sell-offs, but the light blue line, which is bonds, they've by and large held up during those periods, because there has been this expectation of a continuation of very low interest rates and quantitative easing to continue. Now, with the advent of inflation, that has clearly gone away, and we're seeing both equities and bonds fall in the face of rising rates. So for an investor, much more difficult, particularly if you are a cautious investor or a balanced investor, where you will have a decent exposure to corporate bonds. You've got most of the major asset classes within your portfolio falling at the same time for the first time in quite a while. Long term, nothing to worry about, because actually for a fixed income investor, what you want is interest rates to go up, so you're receiving a bigger coupon. But the mechanism of getting from where we are now to those higher interest rates is going to be slightly uncomfortable. So that's all reasonably depressing. Let's try and find a bit of a silver lining. We've had a lot of questions come through around how much further do we think the market might fall, or is this a good time to invest? And of course, almost an impossible question to answer, just because of the multivarious nature of all the things that affect stock markets. But there are nonetheless a couple of things that might lead you to be a little bit more bullish when it comes to expectations for equities. And this rather perversely is one of them. So this is the Bank of America Global Fund Manager Survey, where they ask fund managers a variety of questions, including this one, which is how much risk are you taking, relative to how much you would in normal conditions, and it's a measure of how bullish or bearish institutional fund managers are. And you'll see that managers are extremely bearish. They're taking very little risk, and in fact, they're more pessimistic now than they were during the height of the GFC. So why is that a good sign? Well, it tends to be a precursor for markets to improve, because essentially once everybody has given up being optimistic and there's nobody left to reduce down their equity positions, that tends to be the point at which markets can be can start to rebound. Of course, it's not guaranteed, and we are we are hostage to fortune in terms of everything else that's going on in the world, but nonetheless, it's tended to be in the past a pretty good indicator for equity markets moving forward. So that's reasonably positive, and then related to that in terms of how much further the market may fall. It's important to bear in mind that there's probably two key drivers for the market right now. And if we go to the next slide, we can just address one of those. So the other is, obviously the sanity of the situation, which is how the global economy is doing and whether we go into recession, how that affects corporate earnings. And George might touch on corporate earnings a little bit later on. But the aspect that we've spoken so much about in recent times is just the artificial nature of financial markets, in that they are so affected and impacted by quantitative easing, by central banks trying to prop up economies by providing excess amounts of liquidity. We're now in a situation where the Federal Reserve at least is trying to withdraw some of that liquidity, and the light blue line is the expected withdrawal, the quantitative tightening that we expect to see in markets, and the dark blue line again being US equities. And you can see there's a clear correlation between the two. As the Fed pumps money, equities do very well out of that, and then as there's this expectation that it withdraws the money, equities decline. But equities have declined quite quickly over quite a short period of time. So we think that they've probably accounted for around 45% of all of the money that was pumped in during the COVID period. So there is sanity and within markets, and it seems that they are looking forward, certainly with regards to liquidity. With regards to corporate earnings, that's quite a bit more complicated, but it's reasonable to suggest that certainly those overvalued areas of the market have sold off to a decent amount. Let's just investigate that little bit further on the next slide. Here we're looking at growth companies against value companies. So you might recall, if you've been on our webinars before, growth companies being those that have very ambitious growth intentions, and the point being that they will reinvest a lot of their cash flow back into the business to try and pursue that further growth. And by contrast, value companies tending to be those which are a bit more mature, a little bit more established, have a bit more predictability around cash flow, and would tend to distribute their profits and earnings back to their shareholders. And all through the last sort of 5 or 6 years, and certainly during the COVID period, those growth companies, in particular tech companies, have done extremely well, and they've massively outperformed value companies, the more boring, steady dividend payers. And what we anticipated, and indeed what we've seen, is that reversed around the start of this year. So within our portfolios, we put very much more a value tilt into the equity exposure, because we felt that the way in which these growth companies were valued, i.e. by reference to very low interest rates, was going to be challenged, and indeed that is what has played out over the first half of this year. So that was a reasonably good move within the portfolios to come out of growth to a certain extent. We've still got a balance in there. And then again, I think just on the next slide, another example of how the market has regained a little bit of sanity is in those more, shall we say, esoteric, the slide says strange and exotic, but those esoteric asset classes, if indeed you can call them asset classes, things like cryptocurrencies, and what we've got there, the light blue line, the SPAC index. So SPAC being standing for special purpose acquisition companies. So these were companies that where a lot of money was put into them, where the intention was the company would go and buy a private company and take it public, and therefore effectively bring it onto the public market. And this was a huge area last year. We think last year there was around about 1,000 SPACs set up, but in actuality there's only about 400 of them have ever found a private company to take public. So this is a little indication that there's far too much money sloshing around the system trying to find investment opportunities where investment opportunities are very difficult to find. So not only have you had a lot of SPACs actually returning money to their investors saying we simply can't find anything to invest in, but those that did find something to invest in have actually performed extremely poorly. So in the UK, a couple of examples, Arrival, which is an electric vehicle company, has lost around 90% of its value since it was taken public via a SPAC, and about the same fall for Kazoo, the sort of online car supermarket. Their share price lost about 90% also since that was floated via a SPAC. So all these sort of bubbly areas that we've spoken about in the past, you can see that they've been really badly affected by the change in sentiment and the prospects for recession. Bitcoin is showing its usual volatility. If you'd have been in Bitcoin at the start of this year, you would have lost an awful lot of money. I know we've had a couple of questions on Bitcoin and crypto generally, so maybe we'll get to those in the Q&A. So suffice to say, we didn't have any of those in the portfolio. They tend not to be traditional asset classes, but nonetheless, it's a reasonably good sign that some sanity returns to markets. So last one from me then, just to reiterate the point that we started on around the US dollar. So within our portfolios, we tend to hedge around half of our overseas equity exposure. Excuse me. But latterly, we've allowed more of the exposure to be unhedged, because we know that in times of stress in markets, the US dollar tends to do particularly well. It tends to do well off the back of its status as the world reserve currency, and also with the US being ahead of most of the rest of the world in the economic cycle, and therefore putting interest rates up much more quickly and much sooner. We wanted to have that exposure to the dollar, and you can see there that pretty much all the other major currencies have been depreciating on a trade weighted basis. So we've had that position in the portfolios by virtue of our unhedged overseas equities, and indeed, as I mentioned earlier, the gold position. So a lot going on in markets. A lot of questions coming through rightly around, will the market go down further, or is this a turning point? And you've seen a little bit of solidity in equity markets over the last few weeks, albeit it is summer and summer tends to be quieter. But maybe we'll come back to that point in the Q&A. And for now, I'll pass to George and he can give a little bit more color about what's happening in the economy.
Thank you, David. Good morning, everyone. So, one of the questions we're getting more and more often is it enough? The S&P 500, the world's leading equity index, is down 1,000 points. Is that enough? And the answer is no. The term we often look for is capitulation, the point where stocks are just oversold, and therefore it's a buying opportunity for everyone. And definitely we're not there yet. It would take a significant drawdown, maybe even another 1,000 points at the S&P 500, currently at 4,000 points, maybe even more than that. But we don't have to reach the point of capitulation. Not all rebounds start when everything is destroyed. Rebounds can start a lot quicker, and if somebody, for whatever reason, is out of the market at that time, then they're just playing catch. So keep that in mind. Yes, we're not at the point where everything is oversold, but we never really have to be at that point. There is nothing in theory or practice which suggests do not buy equities, do not buy bonds unless everything is destroyed. Okay, yes, we're in the middle of a paradigm shift. Yes, it will take time for a lot of valuations to come back where they were. Yes, a lot of the growth companies out there, your Amazons and your Teslas and all of these, may never reach valuations like the ones they saw a year ago, a year and a half ago. But that's okay, because this is part and parcel with investing. Today it's tech companies. 20 years ago it was banks. 50 years ago it was all companies. 100 years ago it was all railroads. So who's at the top changes. Okay, and we just have to come to terms with that. Now, before I go on to the next slide, sorry, actually no, Harry, let us go to the next slide. It sort of fulfills that point. If you're a long-term investor, you will not lose. Holding a portfolio at any given point in time, just for a month, the probability of losing money is about 1 in 3. If you hold it for a year, which is really the minimum you would ever hold any sort of portfolio, is the probability of loss is about 15%. If you hold it for 5 years, or a short-term investment horizon, because that's what 5 years are, the probability of loss is 4%. If you hold it for 10 years, which is a good average investment horizon, the probability of loss is less than 2%. Now, these are averages. Today, we are at the point where we have lost 1,000 points, or almost 1,000 points, versus the top of the index. So really, if you look at the numbers, the probabilities for losing money, even over 5 years, tend towards zero. The reason we didn't put them there is just we don't have enough history of drawdowns as big as the one we saw. So, statistically, 7 or 8 instances that were not that important. But the point I'm making is that we have fallen a lot. And people should not be thinking about, oh, what the bottom is, I should go back in there. They should be thinking, from here on, what is the probability that I might lose money? Now, Harry, can we go on to the next slide? Let's talk a little bit about market cycles. And those of you who've attended those webinars before will have seen this slide. At some point, for whatever reason, central banks loosen their supply of money. They fill the economy with money. If they can do it, they will. And eventually, that money becomes inflationary. Now, in our case, it wasn't central banks that did the inflation. It's very important to say that. Inflation is mostly because of Ukraine right now, and because of China, and because of supply chain. It's mostly supply driven. But for whatever reason, we have inflation, which then tells the central banks to tighten, which is exactly what's been happening since January. This was very important because loose monetary policy was underwriting all investments in the world, essentially. Okay, so losing that, that is really what took the floor of investments. That's why the chart David showed you early on, where for the first time in recent recorded history, both bonds and equities are dropping together like bricks. And obviously that's causing a lot of problems for diversified portfolios. So now you have what is known as a financial recession. And that, that's still the case. Obviously, it was obvious that we're getting into this in the onset of Q2 this year. After that, when these things start to crumble, investments, we don't invest in companies, therefore companies don't invest in themselves. They freeze hires, they don't expand into new projects. They're saying, oh, people won't have money enough to buy our product and what have you. So that's how you enter an economic recession. Now, a small caveat here: an economic recession technically is 2 quarters of negative GDP growth. In reality, it doesn't have to be as much. Since 1980, the economic growth overall, economic output has doubled, but the buying capability for an average worker has only risen by 33%. So the total economic output is more than 6 times what the average person can afford to buy. That tells you that a lot of people, especially those on salaries, or even worse, those on the lowest part of their salaries, are already experiencing a heavy recession. Okay, average GDP does not have to be negative for us to be in a recession. This is where we are today. And then the question is, when will that recession become more important than inflation? And again, it might not be technically a recession, but policymakers are considering lower incomes and they are asking themselves how much is enough. Now, when that happens, and we don't know, it could be either because inflation recedes, or it could be because the economic woes outweigh the impact of inflation, or even the danger of de-anchoring, as they say, inflation expectations, i.e. People assuming that inflation won't be at 2%, it would be at 5%, therefore they would go and ask a raise of 5%. This is what policymakers are really afraid of. So if the economic woes outweigh that, or inflation drops, then this changes the calculus and central banks start printing again. And this is the biggest boost you can have for risk assets, especially since for the past 14 years, risk assets have only learned to go up because of central banks. Now, next slide, please. Inflation will probably be with us for some time. Now, first of all, supply chains are still in distress. If this particular index is over 0, it means that the delivery conditions around the world are stretched. Yes, it's dropping, it's closing towards normality, but it will take some time. It will take a few months before we are back to, what even resembles a normal supply chain. Next slide. Also, inflation is measured, that's econometrics, and you really don't have to know this, but I have to say it because that's the headline number you see out there. It's called year-on-year inflation. Okay, we take the price of a mouse last year in July, and we say, okay, last year this cost 10 pounds, today this costs 11, therefore inflation for a Logitech mouse is 10%. So this is how we measure inflation. And last year in the summer, inflation was actually lower. So when you look at on a year-on-year basis, this year, because of all the things that happened in Ukraine and in China, inflation will actually be a little bit higher. Now, commodity prices, global commodity prices are receding somewhat, but we don't anticipate inflation to slow down before, say, November. This is at least the market consensus. Now, next slide. In all of this, because we have tighter central banks and economies that are not doing very well, and markets that are just not performing, all the risks become bigger. And one of the biggest risks that we see out there is the same risk after the global financial crisis, which happened in 2009. 2 years later, Europe, the Eurozone, which is a badly designed currency union that has not changed, was in danger. Today, in fact, we are seeing similar dangers. We're also looking at geopolitics and how they affect asset returns. We're looking at China, we're looking at the possibility of a global recession. And generally, when we look at risks, most of them now go into the worry more in the worry now column. When there is a lot of liquidity, these would move back to worry less, worry later. But as there is little liquidity, then things might start blowing up. So this is what we're laser focused on, this sort of graph. Next slide, please. The two areas which we have identified as being the areas with the larger risk, one is, as we said, the EU, and generally the bond market, especially the EU bond market, we are seeing signs of dislocations. And second one is high yield in emerging markets. Why? A lot of these countries have debts in dollars. Dollar is spiking up, as David showed you, so they have to pay more money to facilitate their debt, and that is obviously beyond some of their capabilities. Which means now, if you buy a Chinese high yield bond for which in 2017 you would be paying around 6%, 7% on, now you're paying an eye-watering 27%. Okay, for Asian high yield bonds, that's 20%, up from again 6 to 7%. So we are seeing in the Asian high yield space a lot of distress, as much as we are seeing, even more actually than what we're seeing in Europe. Next slide. Now, in this environment, obviously, growth projections are to remain weak. And honestly, I cannot keep producing those charts fast enough. The IMF came out yesterday and further downgraded UK growth for next year from 0.7% to 0.5%. And if I look at again next month, it's probably going to be lower than that. The UK especially is deemed to be a weaker economy than its OECD peers. And that is because inflation could drag on because of dislocations associated with Brexit, i.e. a lot of Eastern Europeans went back home, a lot of job vacancies are left unfilled, and until such time as people are trained to pick up those jobs, this creates an imbalance in the market, raising the prices, wages and prices for goods. Next slide, please. And to be, perfectly clear about this, look at bankruptcies in the UK. On a year-on-year basis, it's the worst they have been since maybe 1980. Okay, and the economy, that's exactly what this feels, what feels like, probably what it felt like in the early 80s. Now, next slide. When we talk about inflation coming down, the problem is not markets. Markets are actually quite sanguine about inflation. They assume inflation is going to be 2.5%. That is your thick blue line. But short-term inflation is already at 5 or 6%. And again, that doesn't matter for the Fed. The number that really matters is that golden line, which seems pretty stable, long-term inflation expectations by consumers. So mercifully, this is still stable. And this is the silver lining in this economic slowdown that I'm talking about. People don't assume that inflation is going to be a huge thing for a very long time. That means that their purchasing decisions, their wages will not be decided on the current very high numbers, but on the long-term numbers, which is great news for policymakers. It's great news for us who hold financial assets, because what we really want is for those policymakers to put more money into the markets, and maybe asset returns will improve thereafter. Now, yes, George, but at this point, rates are going up. So how high might they go? Next slide, please. There is a lot of debt out there. If you're the QK government and you owe 120% of your GDP, you don't want to be paying a lot on that debt. So you'll do whatever it takes to keep longer rates at 2%, 3%, okay, maybe 4% over the short term. Okay, and that's where you should expect to see, terminal interest rates. The interest rates that we saw in the 80s, which were 20% interest rates, simply put, in this world with such high debt, they would be unsustainable. All countries in the world would go bust. All major currencies would just take a dive. It would be chaos in the currency market. Next slide, please. Also keep in mind in terms of long-term inflation expectations that we're still a very much globalized society. Yes, China is more expensive, and yes, energy is more expensive because we used to get directly from Russia. Now it goes through India and we buy it from there. Because that's the logic apparently, and that's just more expensive. But when you think about how we manufacture goods, fine, something is manufactured in China, now it can be manufactured in India, it can be manufactured in Vietnam. The world is still global, and the economy is still global. In fact, that's why we have such a difficult time, calibrating it. But that also means that longer term inflation expectations should not go very high. Longer term inflation should not go very high. So yes, we are seeing an economy that is in distress. We are seeing global markets that are in distress, but we're getting closer to the point where central banks might change their policies despite of what they're saying today. As David put it, yes, the Fed will probably raise another nearly 1%, not 0.75, but we are drawing closer to the point where this dynamic might shift. Okay, rates are going to go up, especially in the US, very quickly. But I'd like to remind everyone that the Fed has not taken money away from markets yet, although it said it would. And to me, this is the big signal out there. The Fed is signaled to markets, we will control this inflation, but also it's signaled to investors, don't worry about all the liquidity out there. We're not really retracting much of it. And that informs me that the Fed put the promise that central banks will continue to underwrite risk when risk becomes more pronounced will be there. And that, if anything else, this is the sole reason why somebody should have a long-term investment portfolio, because the powers that be, the policymakers, will reward you for having one. So to recap, next slide, please. And final one from me. Times are different. What we're seeing is the end of a 40-year regime. This is the modern monetary regime, which started in 1971, and we will be looking for a new paradigm. Make no mistake about it. It is a time to be cautious. It's not a time to be complex or leveraged or go into Bitcoins and all of that just because at 20,000 they appear to be cheaper than what they did in 60,000. It is time to be cautious. It's still time to be diversified, and it is definitely the time to be liquid. It is also the time to focus over the longer term. Why? Because A, in the shorter term, everything looks bad. B, visibility is really very little. It's near zero. So there's no decision you can make anyway in the shorter term where you can have a decent understanding of the risk and rewards. Okay, so you need to focus over the longer term. Ask yourself, is it still worth having a portfolio over the longer term? And this is the number I will leave you with. Since 1980, average economic growth was 200%. So global economic output doubled. At the same time, the value of the stock market went up 9 times. So the economy doubled, but the stock market grew 9 times. This is how investors are rewarded for holding investment portfolios, even when the economy is going down the drain. And I will leave you with this thought.
Excellent. Thank you very much indeed, George. You and I have probably spoken for far too long. We've left ourselves not an awful amount of time for Q&A. So let me fire some at you very quickly, and maybe if we can have some brief responses, if that's possible, George. let's just take one of the pre-submitted ones around the NASDAQ in particular. That's US tech stocks around 30%, far more than, say, the FTSE, for example. Do we see that reversing, or have we just seen something similar to the dot-com burst that we saw at the start of the century?
Growth stocks benefited from the latest round of quantitative easing a lot, as now this we don't have quantitative easing anymore. The air has been let out of them. So, if somebody's thinking about buying Tesla again at 1200s their annual earnings, then probably no, that will not happen again. Those valuations, which were by any measure, they were nearly insane, in this environment will probably not revisit them. It will take the next bubble essentially.
Quite, thank you. I mean, worth saying that we're not necessarily negative on tech. We've seen some really good earnings, or decent earnings from Microsoft and Amazon this week. It is just the fact that they got a little bit overvalued, a little bit of over exuberance in the markets, rather than being something fundamentally changed in their business model. Several questions, George, and we had a slide on it earlier on about Bitcoin. We don't have Bitcoins in our portfolios, and we don't intend to. I wonder if you can just talk a little bit around that.
The volatility of bonds is around 5% per annum, which means you buy it and there's a good chance it will go up 5% or down 5% per annum. The volatility for stocks is 15%. Interestingly enough, the volatility for gold is 17%. The volatility for Bitcoin is a whopping 77%, which means at any given year, there's a large probability you might double your money or lose all of it. In a normal investment, there is, for somebody who's willing to take that risk, it's still something investable. But for 99% of investors out there that usually are not ready to take the risk of total loss, Bitcoins and the such don't have a place in the portfolio. And as a very wise friend of mine once said, for something to become an investable asset class, it needs to have some value. It needs to offer something. Bitcoin offers very little. It is just a perception of value coming from an arbitrary place.
Sure, thank you. And that might change in the future, or indeed we might see other cryptocurrencies becoming much more widely used as a currency rather than just as being something you speculate on in the investment world. But for now, we don't really see that being the case. Lots of questions about interest rates. I think you've answered most of those in your slides, George. So let me finish off on this one. Is a fundamental question. I mentioned earlier that we're not in the business of predicting short-term stock market movements, but there is a question about what would the set of circumstances look like that would, in our view, cause a bear market to move into sort of a bull market. What would we want to be seeing? What are we keeping an eye on in that space?
We would like to see better valuations. We would like to see inflation coming down, or at least commodity prices coming down, or at least supply chains improving materially, or 2 or 3 months of downside inflation surprises. It would take a combination of these things. Obviously, we would like to see better momentum. Currently, equity momentum is very, very bad for all markets around the world. And we would also like to see those systemic risks like the EU or emerging markets in distress space. We would like to see some of the systemic risks go away as well, because if you remember, David, stock markets started rebounding in 2009, and in 2011 we were again at the next crisis, which was the euro crisis. So with spreads out there that high, even if we saw better momentum, a better valuation, and even lower inflation, I would still be cautious of the systemic risks out there. But if we see those systemic risks coming off, and the combination of lower valuations, lower inflation, better momentum, not necessarily everything looking rosy, but some of this looking better, then yes, it would be time to go back risk on for portfolios.
Excellent. Thank you very much, George. Let's hope we get to that position sooner rather than later. Lovely. So we will leave it there. All that remains for me to say is thank you for choosing to spend your time with us this morning. We hope you found it informative. As ever, we will send out the slides and a recording of the session to you over the next couple of days. But if you wanted any sort of follow-up with myself or with George or any member of the Mazar team, please do let us know. We don't yet have a date for September's webinar, but it'll probably be around this time of the month, so towards the end of September. So keep an eye out on your inboxes. I know some people get the invites going into their spam, so maybe just worth having a check in there from time to time. But other than that, thank you very much for joining us. We appreciate it, and we hope to see you next time. Thank you. Goodbye.